Tesla is splitting their stock 3-for-1 on August 25th. By the way, speaking of Teslas, we're giving away a Tesla for those subscribers to our channel, subscribers to our software. So if you're interested in it and you also want the best software out there for financial investing, check it out at everythingmind.com. So what does a stock split mean? Guys, I was in high school, sophomore year of high school, Algebra 2 trade class. My teacher was the track coach at my high school. And a kid raised his hand and said, hey, do you own Nike stock? Because he was a track coach. He said, I wish, I just can't afford it. It's too much money. What he meant was the nominal price was too high. He didn't feel like he could buy enough shares. Guys, this is complete and utter bullcrap. The saddest thing I learned when growing up was how dumb my teachers were in high school. I had some brilliant teachers, but far and wide, they weren't very smart, but it's okay because this is a very common error. They're just regular people like you and I. So let's go over this. Let's say Tesla's currently, I don't even know what the exact price of Tesla is, but let's say it's $750. If they're going for a 3-for-1 stock split, their price becomes $250. So you might sit there and say, hey, Paul, you big dummy, $250 is less than $750. Of course it's cheaper. Okay, so let's go through some math real quick. Let's say a company makes $1,000 a year and they have 10 shares. Each share gets $100 per year, right? Theoretically, earnings per share is $100 per year. $1,000 made divided by 10 shares. Let's say do a 10-for-1 stock split. Add another 100. Add another 0. They're getting 10. Okay. This means your stock is more valuable. Guys, you're just splitting the pie up amongst more shares. That's all you're doing. You're making the stock cheaper from a nominal perspective, but it still gets you the same amount of money per total. If you owned if you owned 15 of these shares, let's say you own 20 of these shares, you get $200 in total. But when it was only 10 shares, you own 2 of them. You also got $200 because it used to be $100 per share. It's the exact same amount of money. So don't be that gullible person who believes just because a stock split is occurring, it's making it cheaper. But spoiler alert, this is exactly why companies do it. They want the average person to feel like they're getting more. I'm buying more shares. I own more of the company. You own exactly the same amount of the company as you did before. You just feel better because you get to put in a 20 for your purchase instead of 2. Because it's so demoralizing to buy 2 shares. Oh my God, 2 shares. But guys, you have found this channel and you stuck along in this video long enough. What you need to remember is, I'm Paul. I'm a value investor. My goal is to teach you the things that people won't teach you out there or you haven't learned. Just like my Algebra 2 trig teacher in high school had no clue that Nike stock being 50 or 5 was no different. It all depended on the number of shares outstanding. Okay? What we're doing here in that example is showing you that when Tesla splits their stock and triples the number of shares outstanding, they're just tripling their profit and revenue and everything else more ways. You get that many more shares, so your total number that you're accounted for in those shares does not change at all. All they're doing is they want to make sure they want to pump up the excitement and have more people enter. Oh, I can buy more shares. Let me go buy more shares now. And it drives the stock price up. It's a complete marketing tool. So we're going to pull up Berkshire Hathaway Class A shares. Berkshire. Class A. What's that stock price? 452,000. Okay? Look at the market cap. The market cap is all the shares multiplied by share price. 667 billion. Okay, let's go to Apple now. Apple, share price, $164. Oh my God, Apple's so much cheaper. It costs $2.7 trillion, 4 times more to buy all of Apple. It's less than 0.04% of the company price, stock price, but the value is 4 times higher. That's exactly what you need to remember. It's all about how much you're getting per share. Just like when the company dilutes you by issuing more shares out to fund growth and things like losses, they're diluting you, they're issuing more shares and splitting the pie up amongst more and more people. That is what you need to learn. If you're here listening to this and you've listened this long, it means you kind of get it. You kind of understand that all the things out there that you're reading and hearing are probably all baloney. I want you to remember that. There is a structure to investing. It can be a lonely road out there when you're out there going, all your friends are saying, hey, dummy, Tesla stock's gonna be 1/3 the price. Of course it's better. No, they issued more shares. Now, if before August 25th, the stock price went from 750 to 250, yes, the stock is cheaper because they haven't issued the shares. It was just a drop in price of the company and a drop in market cap. But until that happens, and if August 25th hits before that happens, it's just splitting the shares up, the company up in more shares. That's it. Don't fall for that trap. The reason why Warren Buffett has $425,000 shares is because he always said, I want partners of mine. And he looks at shares of stock as business ownership. And if you buy a share of his stock, you're a partner of his. He said, I want partners of mine to be long-term focused. And if I have an expensive stock price, that long-term focus is more likely to occur with people spending a lot of money. When he first started buying Berkshire Hathaway stock, I think he was paying $7 per share. It's gone up to $425,000. That's quite the return. But that's years and years and years and decades of compounding at 20% a year. That is what's so wonderful about his company. And you better believe, if you own a share of a stock, you're a big believer in him. You're going to let him do what he needs to do. You're a long-term believer in his process. Nobody's day trading $425,000 stock. Now, they did create Class B shares for exactly the reason of letting some people buy in, but even those are hundreds of dollars a share. So just remember that when you're going forward, and now you can sound so much smarter when all your idiot friends say, I can't wait for the stock split because I got more Tesla shares. And you say, well, it's not really much different because it's actually not different at all. And it might boost the stock price up temporarily. But we've always seen in history that what ends up happening in the short run is stocks are a voting machine. In the long run, they're a weighing machine. So those stock splits in the short run do increase the votes for the company, essentially. It increases the demand, and the stock could go up. But in the long run, what's going to matter? The fundamental valuations based on the fundamentals of the business. As revenue and profit go up, as long as they start at a reasonable level, the stock price will go up with that level. But if you're like Tesla, which I believe is massively overpriced, then you will be able to see that the stock will go down no matter what happens there. Now let's go look at Tesla using our 8-pillar process and then put our assumptions in the stock analyzer tool to determine what to pay for the stock today. And I'll show you how it's going to be affected by the stock split. So we go to our software and we pull up Tesla. So if you have our software, please follow along. If you don't, the software is wonderful. I highly encourage you to take a look at it. So guys, in the last year, the 52-week high for Tesla was 1243 and the low was 620. After the stock split happens, this is going to change to roughly 414, and this will change to 206. That's it, because all they're doing is issuing more shares. It divides everything by 3. All right, so our 8 pillars. Let's go right up here to the top, go to our 8 pillars tab. Okay, a lot of X's here. Does that mean you avoid the company? No. Tesla's a fast-growing company that has absorbed some losses along the way, and they're growing, and they're doing a great job. They're going to sell 1 million units this year, if not more. But one of the things I want to show you, this is not a stock split. They have issued 25.5% more shares. They've increased the number of shares outstanding by 25.5% over the last 5 years. That means if there were 100 shares 5 years ago, there are now 125. So if you owned 1 share, you owned 1 out of 100. Now you own 1 out of 125. You have been diluted. Your percentage has gone down. When a stock split happens, 100 goes to 300, but your 1 share now becomes 3 shares. They give you more shares. That's the difference between a stock split and issuing shares and diluting people. Please rewind that part if you don't understand that, because that's extremely crucial. In a stock split, you are given more shares. In dilution, they just issue more shares and you still have the same number of shares you did before. Now, a lot of debt, not as concerned about it because their free cash flow is probably lower than it should be because of reinvestment. Low return on invested capital, which is driven by free cash flow. But look at these multiples, guys. 5-year PE, 520. 5-year price of free cash flow, 577. Now, all you Tesla fanboys out there are going to be telling me, Paul, it's a growing company. Jesus Christ. How do you grow a $900 billion company? You guys really believe this is going to become a $6,000 stock and this stock is going to be a $5 trillion company? It could happen. It ain't going to happen this year. It ain't going to happen next year. And it's probably going to fall very, very hard before that happens. But let's now use our stock analyzer tool to determine how much to pay for Tesla based on our assumptions about the future. Because remember, every investment is the present value of all future cash flow. Everybody in our community, the thousands and thousands of people in this community, always repeat that line kind of jokingly with me because they say, remember what Uncle Paul says, every investment is the present value of all future cash flow. If I were to give you $1 a year for the rest of your life and told you to pay me a sum of money today for that, that's what you're doing. You're calculating what are the chances that you stay alive for a long time? What are the chances Paul's able to pay me for a long time? How much will inflation be? You factor all those things in and you pay an amount of money based on a return you want. Same thing with a stock. We don't know these unknowns. How much will they grow? What will their profitability be? Who will the competition be? Et cetera, et cetera, et cetera. Those are the things. That's why investing in stocks has a higher rate of return than bonds. Because bonds, for example, the U.S. government 30-year treasury, it's much easier to say the U.S. government will be around for 30 years and they'll probably pay me. Tesla could be around for 30 years, but are they going to be more profitable, less profitable? Remember, 30, 40 years ago, who thought GM, Ford, and those guys would not be the #1 car manufacturer in the world? And it changed. So we can do a 1 to 20 year analysis. I always pick 10. First line, revenue growth assumptions. Now look at this number here. They did 54.6% revenue growth over the last 10 years. I used these previous 1, 5, and 10 years numbers to kind of give me a feel for this. However, guys, they're going to sell 1 million cars. If they did 54% growth for the next 10 years after being in 1 million cars, 1.5 to the 10th power, they would be selling 58 million cars a year. Guys, the entire world doesn't sell 58 million cars a year. Okay? Maybe it does now. But the entire world, come on, it's not going to take over the entire world. So what's more reasonable? Let's say they become the #1 manufacturer in the world in 10 years, and they sell 10 million cars a year. That's 10 times growth over the next 10 years. 25%, which I still think is very high because anything can happen. And remember, you see major car companies like GM, Ford, Toyota, everybody's making electric cars and doing a great job of it. I will say, I think Tesla has the best electric vehicle out there. I have an electric vehicle that is not Tesla. I think Tesla has the best electric vehicle out there. I'm separating company from stock price, okay? I can think the company's phenomenal and the stock price is shit. So, somebody's sending me a message. Not now. Low side, let's do 10% revenue growth. Middle, let's do 15%. Now, profit margin. Last 10 years, it did 3%. Guys, I think this is too low. I think they're going to have a healthier margin than this. But who knows what it's going to be? 4, 6, or 8. I'm putting that in. Free cash flow, I'm going to do the exact same thing because over long periods of time, earnings and free cash flow should be pretty similar. Now for PE. Guys, they're currently at a 95 PE and 130 price of free cash flow. So you're going to tell me, Paul, 95, give it a discount. Let's go to 50. No. The bigger the company is, the harder it is to grow, the lower the PE should be. The historical average for companies is 15 or 16. Once this company becomes the #1 car manufacturer in the world, it will be hard for it to grow further. I'm going to assign 14, 16, and 18. Same with price to free cash flow. And I'm going to put a 12.5% return in here because you can get 9 or 10% from a normal ETF. So getting yourself a little margin of safety and a little bit higher reason to go do this. I actually want to put in 15%, but I will do that after. So stay a little bit after I hit the analyze button, stay a little bit longer because I'm going to show you if we alter these numbers just a little bit to show you how overpriced Tesla is. So I hit the analyze button. The stock is currently at 871. It's going to show you 6 numbers here. A low, middle, high for earnings ratio and a low, middle, high for free cash flow. Guys, look at this. We have a low price of 46. We have a high price of 327. Keep in mind, this high price is based on it becoming the #1 car manufacturer in the world, selling 10 million cars a year in 10 years. And it's still overpriced there and in the middle of about 100. Now, one thing to keep in mind, this is way higher than it was for me before. And as the company gets better and better, that number is going to go up and up and up. But at some point, this and this have to connect. And it usually happens when this goes faster down because it's much harder to get fundamentals better than stock price lowering. So let's go back like I said I was going to do, and let's change some of these assumptions. Let's change the PE, 20, 25, and 30, which is obscene for a car company that's selling millions and millions of cars a year. Guys, look at this. A low of 58, a high of 47, a middle of 150. If you hate me, comment below. Just say, Paul, I hate you. If you like this video, I appreciate it. Subscribe to this channel because I'm speaking to you in some way that makes sense to you. I appreciate all your time. And again, watch the next video on our 8-pillar process so you can understand it better and learn this process to understand stocks much easier. Subscribe to our channel. Thank you very much.